Hello everyone. Good morning. So today is our first class of SP7. Before starting with the course, we would first discuss the entire material, entire syllabus of SP7 and SP8, which is the specialization paper for general insurance company. Right. So let's start with the discussion. If you have any doubt, you can stop me in between. We can take the doubt then and there. We can clear the concepts and then we can move ahead. Okay. So firstly, we'll look at the syllabus for SP7, right? So there is in total 27 chapters for SP7. In SP7 and SP8, starting few chapters are common, right? So you don't need to worry about the chapters number because most are common and very general in nature. You already know most of the knowledge, you have it. So let's see one by one what chapters and what topics are we going to cover in both SP7 and SP8. So in SP7 we start with insurance company and key terminologies. So this chapter over here is the key is the overview of the entire general insurance company. This would be same for SP7 and SP8. Both SP7 and SP8 has the first chapter as insurance company and its key terminologies. Over here we will learn about some abbreviation short forms that are generally and commonly used in the industry. We'll understand something about the business, the products and all. So this would give you a start to the course or the entire general insurance structure. After that, we have a background to the product, type of insurance product. So these two in common, in combined, will let you know what type of products we deal with in insurance company, what are its characteristics, what kind of claims you can expect in that, what kind of reserves. Is it a long tail business or a short tail business? A long tail business is one where the reporting and the settlement delay is very long. So, say an accident has happened in 2020, but it got reported in 2022, and this is a third party claim wherein a car driver has hit a person. He is in the he was severely injured or not in a position to claim. So what happened that although the accident happened in 2020, the claim was reported in 2022 when the injured was in position to make a claim. The claim was registered in the court of law since it is a third party claim, injury claim. The claim has to be registered with the company. The case would be fought in the court of law. Then the court will decide what kind of compensation will the insurance company will pay to the third party on behalf of the insured. So uh, that case could take a long time, right? Because since the court is involved, you don't know how much hearing it would take, how complicated the claim is, how powerful the third party is. The claim could go as high as in crores or can in settle in thousands or lakhs as well. So there are a lot of complications when a claim is trialed in the court of law. So it could take a lot of time to settle. Say it has taken to 2025. In 2025, the claim was settled, finally paid, and closed. So, yeah, so what I was saying, Sorry. Good morning, everyone. Today is our first class for SP7. In today's class, we will understand what is the subject matter for SP7 as well as for SP8. So SP7 and SP8 in combine is the specialization paper for general insurance company. If you are a general insurance actuary or working in a general insurance company, you need to take these two exams as your specialization paper. One deals with the capital modeling, reserve risk part, and reserving part of the course. The other deals with the pricing methodology. So SP7 is the reserving paper. So the name of the paper, if you see, is General Insurance Reserving and Capital Modeling Specialist Principle. So over here in this subject, we will we will look at the reserving part. Reserving are of two categories, deterministic, stochastic. We will learn as we go forward, and capital modeling. So this paper deals with these 2 points. And SP8, this is the pricing paper. So if you look at the name of this paper, this is insurance pricing. So these two papers needs to be studied in order to be qualified as a uh, general insurance actuary. Apart from this, there is a advanced paper also, specialist advanced, so SA3, which is the final paper for general insurance. But today, in today's class, we will be focusing on SP7 and 8 only, the specialization paper. So let's first start with the syllabus for SP7. So in so if you see, the total number of chapters in SP7 is 27, and the total number of chapters in SP8 is 21. So you would think that 27 plus 21, in total we have 48 chapters. So this is not correct. The catch is, if you look closely, the first 10 chapters in both SP7 and SP8 are common. So both SP7 and 8, for the first 10 chapters, teaches you what is the insurance background, the key terminologies, products, about the background and type of product. Then they also teach you about the regulations, then some general reinsurance background, right? Uncertainty, data. So these chapters are common in both SP7 and SP8. If you look at the syllabus for SP8 as well, if you see, first chapter is insurance company and key terminologies. Second is insurance product background, insurance product type, market and external events, reinsurance background, reinsurance type, risk and uncertainty, data. So if you compare, first 10 chapters for SP7 and SP8 are same. If not entirely same, 80% similar. Because for SP7, in some chapters, we would hit on these specifics of reserving. And in those chapters in SP8, we would be studying the specifics of pricing, how it relates to pricing. So it changes only at those point. But apart from that, 10 the entire 10 chapter is 80% or sometimes 100% same. So you don't have to learn those chapters again in the other subject. If you have studied SP8 first, you have an advantage in SP7. If you have studied SP7 first, you have an advantage in SP8, right? After this, let's focus on what is the main part of both the papers. So in SP7, the actual curriculum, if we say, for reserving specific for the paper specific curriculum that starts with chapter 14 effectively, wherein we study about reserving basis, triangulation method, stochastic reserving, assessment of reserving results, and reserving uncertainty. So if you go by the chapter's name, the five chapter over here deals with reserving. So this combines, give you a knowledge of the entire reserving process, methodology, thought process that you need to have while you are reserving. So in the start of the class, I told that reserving are of two type, right? Deterministic and stochastic. So there is one chapter, chapter 16, that explicitly deals with stochastic reserving, right? Other than that, in chapter 14 and 15 combined, you will learn about deterministic reserving. So let's discuss in a brief time what is stochastic reserving and what is deterministic reserving. So as you know, deterministic in itself means something which is determined at the start, where the inputs are fixed. In a model, what is a deterministic model? A model in which the inputs are fixed when you start with the model, right? So same goes with resolving as well. If you have studied CM2, you have studied some triangulation method in CM2 as well, right? Classical chain ladder method, and then burn the BF method, and then you have frequency severity method. So there are several methods that you have already studied in CM2 for reserving specific. So those methods would be in detail studied over here in chapter 15, and how you apply them in the real life scenario. What things do you examine? We have diagnostics as well over here, assessment of reserving results. This will teach you the diagnostics that you perform before doing the reserving, and as well after doing the reserving, whether you have performed it right or not, whether your expectations are correct or not. So there are some diagnostics that you will be taught, right? Post that, if we come to the next section, it deals with the capital modeling, which is the second part of the uh, subject, right? So in capital modeling, we have investment pricing and ALM. ALM means asset liability management, right? Then we have capital modeling. So you would see that for capital modeling, we have four chapters. First is methodologies of capital modeling. The next one is risk type. The third one is diversification. The third one is practicality. So if you see capital in the industry, whenever we talk about capital modeling, we talk about risk based capital modeling. What is risk based capital modeling? We we separate out reserves, we separate out money for each risk type. So what we are doing, we are reserving, or we are doing capital modeling basis individual risk type. What are the risk types that we commonly use? It is market risk, insurance risk. In in insurance risk, it is of two type: underwriting. The next one is reserving, right? We have then capital risk, operational risk, credit risk. So most of the risks are of common type, right? Market risk, random fluctuation in the market price of the asset and liability, which leads to a mismatch in your position, is called market risk. Then you have capital risk. Then you have operational risk, credit risk, where the third party defaults. The insurance risk is the one which is new, which is specific to the syllabus wherein you will understand what is the underwriting risk, what is the reserving risk. We'll go into detail of it when we come to the chapter, right? Today we are just overviewing what is the syllabus. Good. Again, the last part over here is the practicality. What is practicality? Some risks are theoretical in nature. It could be for argument sake, like complete diversification. There is never a complete diversification between your portfolio, right? There is always some uh, ये beta that is left, market risk that is left. So those things are not practical. So we will understand what is the theoretical concept, what is the assumptions we are taking. So whatever assumptions we take while doing diversification, while defining risk, those risk may be practical, may not be practical. We would study that those only, which risks are practical, which assumptions are practical, and which are not. Right. The third part, this is the short part, only contains of two chapters, which is the accounting part of the general insurance company. This teach you uh, how do you look at the balance sheet, what kind of like whatever you calculate, the reserves you calculate, where does it fit in the balance sheet? What is your role in the balance sheet? So those things are taught in this part. We also have an interpretation of accounts. This chapter deals with the ratio calculations. You have studied in past as well. What kind of ratios do an insurance company focus on? What ratios should you consider while you are reading the balance sheet of a insurance company? So those things are taught over here in this last part of the chapter, last part of the course, right? So this is the entire syllabus for SP7. If you need to break down it into uh, baskets, you can divide it into reserving, capital modeling, and the accounting part. So in this SP7 and SP8 paper, there are some numericals as well, which is asked in the question paper. So mostly you could expect a 20, rough around 20% marks plus or minus in your exam. Sometimes it happens that only 2 to 5 marks is asked as numerical, rest is theory. But whatever theory is asked, it is not a direct theory from the book, it is application based theory. For that, you need to learn something from your course material, and you need to apply your knowledge as well to better answer the question. So over here, we would deal with both of the thing. We would learn the theory, we will understand the concepts, we will apply our knowledge as well while solving the past papers. We will understand what is the thought process behind solving a question, what are the key parts of the question that you need to underline and you need to answer around those only. The basic uh, remains same, that for 1 marks you need to provide 2 points, so 1/2 marks per each point, so those things remain same. There is no change in that, but we will understand how do you construct your answer so that you could make it qualified as a specialization paper answer. You don't answer in a general sense in this paper, because this is a specialization paper and you are expected to be particular and specialized when you answer, right? So uh go let's understand what is the syllabus for SP8 as well before we can start something. So the first 10 chapters, as we discussed, these are same. We will do these chapters in common when we are doing we will take a joint class for SP7 and SP8. After that, if we come to the main syllabus for SP8, that starts with chapter 11, the aggregate claim distribution. This will teach you the basic claims distribution that you use while you are calculating the expected loss, right? Credibility theory, most of you have already studied in CS1, wherein you apply some credibility factor to your own data if it is not entirely reliable. It depends on how much data you have, how reliable your data is, how confident you are on your data. So we assign a credibility factor basis those things. Then there is a complement of credibility, which is the universal or the other part of the data that you would give some weightage to. So this is credibility theory. Then we have actuarial investigation. It's a general type of chapter wherein you understand how do you investigate things in a general in an insurance company. How do it will help you construct frame your answers better. Wherever you stuck, wherever you don't have points to answer, you can take points from these chapters. The next section comes the pricing method. Over here, you learn about rating methodologies, further consideration, and frequency severity burn cost approach. So, if I have to teach you what is the basic structure of pricing a product, you could go with calculating expected lost cost. So, what is expected lost cost? Expected lost cost is the cost of the claim that you pay. Why expected? Because this is not certain. You are only calculating it while pricing the product, right? So, this lost cost that you are calculating is calculated based on several methods that we have learned in this entire course, which is credibility theory, frequency, severity, and burn cost approach, GLM, multivariate pricing model, original loss curve. So these are the several methods that we use to calculate the expected loss cost. Okay, post that we add some large loss factor. So the claims are of two type, attritional and large. Attritional claims mean which are of similar nature, similar level, small amount claims, and the others are outliers. The outliers we exclude from our calculation of the expected loss cost because it distorts our view. So we exclude those things. There are several ways of handling this large loss. We will learn it while we go deep into the course. For now, you need to understand that while calculating the expected loss cost, we only take attritional claims. We remove the large claim. We add a large loss factor or loading separately. Then we have further considerations, as the name of the chapter suggests. Over here, we consider the changes in the policy wordings, terms and condition, reinsurance arrangement, underwriting arrangement. Then we have a mnemonic called what was that? I don't. Wait. So I don't. Not. I'm not recalling the mnemonics right now. Let's understand what was the mnemonics about. It was about adding factors such as uncertainty load plus profit margin, commission, expense, investment income, tax. So while calculating the price, the premium, all these things are added. Expected loss cost, large loss factor, uncertainty load, profit margin, commission expenses. Only investment income is subtracted because it is an income, an inflow to the company, not an outflow to the company. So this will be subtracted, then tax, right? So this is the general approach of pricing a insurance, general insurance product. These things one by one, all of it, we will study in chapter 12, 13, and 14. Understood? For chapter 16, we have GLM, and then it is further increased by multivariate model. So these two deals with multivariate models only. That's why if you see the group heading is multivariate modeling. And the last one is original loss curve, reinsurance pricing, and catastrophic model. So these three are in individual separate chapters, not much related to each other, but these are related to other chapters. Like as I said, for calculating the expected loss cost, we use original loss curve. Reinsurance pricing is something that we will study with the other reinsurance chapter. And the CAT modeling chapter, this is a short, very short chapter, theory based chapter, which deals with how do you model a CAT event, right? Catastrophic event, flood, hurricane, typhoon, hailstorm, wildfire. So those are CAT event, right? CAT events uh, are of with what nature? CAT events are of low frequency, high severity nature. So these events happen very often, but when happen, it is of huge cost to the company, right? So these are low frequency, high severity claims. Since the nature of the claim is different from the other claims, the attritional claims or the large whatever claims we are dealing with, it's of different nature. We have a separate model to model this cat events, right? And also cat events are very short tail in nature because whenever a catastrophic event happened, you have a window within which you need to register those claims, say 24 to 72 hours window. So whatever claims or whatever events have happened between this window will only be considered as a loss due to that event, right? So these are very quickly registered and very quickly settled also. So because of these things, we deal it separately. So this is the basics of the curriculum. I hope you follow till here. If you have any doubt, you can ask. In today's class, we will start with very basic, the chapter one, which is for both SP7 and SP8, the insurance company and its key terminologies. Right. Before starting this, I will take a pause. If you have any doubt, you can ask, and then we can move ahead with the chapter. Cool. Yes, no one has any doubt. So we can move with the basics of the chapter. So this chapter is the key terminologies of insurance company, right? So the key concepts are key features of the insurance. Let's first start with the key features of the insurance company. What are the key features of a general insurance company? You don't have to have any knowledge for this. You have seen it in your daily life. An insurance company, a health insurance company, a motor insurance company. You take an insurance company in 1 year. If you have a claim within that year, you make the claim, and then in the next year, you again renew that product, right? You renew your policy after 1 year. If you take an example of a health insurance company, a health insurance product, so you have taken a health insurance product for 1 year. You have paid the premium for the start of in the start of the year for the entire year. If you get hospitalized within that year, it could be once in the year, twice, thrice, whatever is the frequency of your hospitalization. Whenever you get hospitalized, you are eligible to make a claim. So, what do you understand by this? That for a general insurance company, you can make multiple claims, right? How many times you are hospitalized, for those number of times you can make a claim. Generally, there is no limit to the claims you can make. But if you have some special policy wherein the premium is less and there is a restriction in the number of claims you make, so those are exclusions, and it doesn't count into the general nature of the insurance product. But the nature of the general insurance product is you can make multiple claims. It is for 1 year period. After 1 year, you make a renewal. So see, the first thing is they are short tail, mostly single year. You can have multiple claims. The amount is unknown. So whenever you get hospitalized, you don't know what would be the bill, what treatment would be given to you, what would be the bill. You are not known, not the company when they sell you the product. How much claim will you make uh, in the in that year? It could range from zero to up to the sum insured that you have. So the amount is not known, unlike life insurance product, where you have a fixed amount that is paid upon illness or death, right? So these are the basic feature. Again, there is reporting delay and settlement delay. We have understood why there is reporting delay and why there is settlement delay. So, say a car accident has happened, right, in 2020. The There was a car. Don't laugh at my drawing. I know it's pathetic. So there is a car. There was a man. This car hit this man, pedestrian, and he or she was injured. Right. This event happened in 2020. This man was in hospital for 2 years, unconscious. No one was there in his family. Nobody could make a claim. Cut to 2022, this man got conscious. Uh, and at that point of time, he filed a case against this car driver, right? So when he filed a case against the driver informed the insurance company that I am being sued for hitting a man, right? So the claim was registered to the company in 2022. So this period over here between 2020 to 2022 is the reporting delay. This period over here is the reporting delay period, right? Then in 2022, the claim was registered in the company. The case was fought in the court of law because whenever there is a third party liability claim, the case has to be registered to the police. It is fought in the court. The court decides what would be the fair compensation to the person, to the victim. So the case was fought in the Quote, since there was a delay for 2 years, lot of evidence was manipulated. Nothing was retrieved so easily. So the court took a lot of hearing, lot of time to settle, and eventually the case got settled in 2025. This man got justice. He got his fair claim. The claim was finally settled and closed by the company in 2025. So the period between 2022 to 2025, this is called the settlement delay. So what is the reporting delay? Reporting delay is the delay between the event happening and the claim being registered by the company. And settlement delay is the delay between the claim being registered and finally being paid off and closed by the company. So over here we have a 5 year delay. Not very short, not very long, decent for an insurance company. 5 years. Sometimes for some third party claim, it takes up to 10 years even to register the claim, right? So the the delay or the entire tail, what is the tail? The time from the event happening and claim being settled. This tail could be as long as 10 years or as short as 2 months, 5 months as well. As I said, for cat events, for catastrophic events, the event gets quickly registered, the claims are settled very fast. So those claims are very quickly registered and settled. So the tail for those claims are short, and tail for liability claims are very long. So what is the general approach? Property claim, wherein you have some damage to the property, your own property, some other's property. Like the property claims are short tail in nature, and liability claims are long tail in nature. So you understand what is the tail? What do we mean by tail of the business? What is settlement delay? What is reporting delay? There are other kind of delays as well. We will study when we'll study the claim characteristics. That's upcoming in the class. After that, let's see how a contract is designed, how a profit is calculated for an insurance company. So for an insurance company, what is the income for the insurance company? The premium that it takes for all of its product, all of its policy. The insurance company also takes some insurance for himself, for itself as well, right? Which is called reinsurance, insurance taken by an insurance company. So for that, it must have paid some premium. So the actual premium that is left to the company is premium net of reinsurance paid. So whatever reinsurance premium it has paid, we will subtract that, and the remaining would be the net premium that the policy that the company has received. After that, since we see that there is delays, settlement delay, reporting delay, the premium is with the company for a longer time before they pay the claim. So if you have some money, what would you do? You would invest it somewhere. When you invest the money, you get income, investment income. So that investment income is also an income to the company. We add it to the income. So these are the inflow to the company. Let's see what are the outflows. Claim incurred, whatever claim the company has paid. Since it has taken some reinsurance, it has paid the premium. It must have recovered something as well from the company, insurance company. So claims net of reinsurance recovery is what is subtracted. Expenses and commission, which is paid to the agent, to dealers, and other person included in selling the product. So those things are subtracted. At last, the tax which is paid to the government, GST, that is taken uh, for each policy, those are subtracted. Whatever is remained at the end is the profit to the company, right? So profit to the company are of two type: underwriting profit and the total profit, right? So what is the difference between underwriting profit and the total profit? Underwriting profit is the profit that the company earns from the operational business of the company. So the what is the main business of the company? It is to write the policy, sell insurance product, and pay the claims, buy, sell. So this is the basic uh, job of the insurance company. There is the business of the business model of the insurance company. So investment income is not something that the company is supposed to make. Like they will make investment income, but it is not in the nature, like not in the operational nature of the business. So if you exclude this investment income, if you exclude this investment income, whatever is the profit or loss, that becomes the underwriting profit and the underwriting loss to the company. When you add this investment income, then it becomes the total profit for the year to the company. Could be loss as well, but generally a company makes profit when it includes its investment income, unless it is a startup, it is in a growing phase, want to capture market, and it is in the strategy of the company to make loss and grow. That's a separate thing. But mostly, well, when we include this investment income, most company makes a profit, right? I hope that's clear till here. After that, let's understand some products, some categories of products that an insurance company sell, a general insurance company sell. The first category is liability insurance. The other one is property insurance, financial losses, and fixed benefit. Over here, if we see the characteristics or the features of the insurance product, it said that the claim amount is not known. But over here, we have some products that promise a fixed amount upon an event happening, right? So it's not that it is very strict that the amount is not known. For some policy, it is known. We'll understand, we'll see how it is known. So let's start with the liability insurance. Liability insurance is what, as the name suggests, it is the liability towards someone. If person A over here is the insurance company, I am the insured. This company is insuring me. I am teaching you, right? If I teach something wrong, you might sue me, right? So if I have to pay you something, that would be liability, right? Me paying you. Same goes with the example that we have taken for the car driver. The car driver hit the person. Now the car driver has to pay for the losses of that person, right? So it is the liability towards that third party. So those things are deal in the liability insurance. How many type of liability insurance are there? Employer's liability. This is between an employer and an employee. If something happens to an employee within the company premises or because of the negligence of the employer. So say I am working in a company. There was a water spillage and I slip in that. I hurt my back. It was because of the company's negligence that water was there. It was not quickly dealt with. I hurt my back, and this is an employer's liability to the company. Why? Because it was because of the employer's negligence. So the key word over here is the employer's negligence. It can't be that you are in your office and you by mistake stabbed yourself. It's not an employer's liability. It's not that you whatever thing happens to you in your office will be covered in the employer's liability. It is to be proved that it is because of employer's negligence that the event has happened. Then it becomes employer's liability. Motor third party liability, we have already discussed this. Public liability. So public liability is the liability to any other person in the road. Whatever liability is not covered in any other sections could be categorized as public liability. Say there was a visitor in your company. When something happens to you, you are an employee to the company, that is covered in the employee's liability. But say there was a visitor to the company and they slipped because of that water spillage. They are not the employee to the company. So then that would be covered under the public liability. Then there is product liability. So say let's take an example of an FMCG company, Maggie. Uh, Lead was found in the Maggie masala. So what happened? Everyone sued the company for the product it made. So because of manufacturing problems, negligence, whatever accident happens due to manufacturing defaults, those things are covered in product liability. It is mostly common in pharmaceutical company because whenever in medicine is launched, you don't know the side effect of it's right there, right. So it take times. Say 5 years, 10 years down the line, you identify someone identified that because of that medicine that I took 10 years before, this has happened to me. I have developed this condition. So what would they do? They would sue the company for the product, for the uh, wrong product or the sub quality product that they have manufactured. So this is covered under the product liability. Other one is professional indemnity. So when with in the start of this liability insurance, I gave you an example of me teaching you something wrong, you suing me. So this is covered in the professional liability. Most of the professionals who are at some position, they take this liability, being it doctors, lawyers, sometimes actuaries as well, advisors, CA, everyone who is in a authoritarian position, who have some uh, impact to the company, they take professional liability because and if anything happens due to their negligence, they would be sued or the company would be sued and the company would recover those things from that person. If they have the professional liability, the insurance company would cover it. Sometimes the premium of this in professional liability is paid by the employer only, and sometimes the person takes it for themselves as well. So depending on what is the arrangement, it could be that premium is paid by the employer as well. Is it clear till here? Next is property damage. So property damage is residential building. You are staying in a house. You have an home insurance. If it caught fire, something happens, robbery, theft, burglary, loss of contents, things are covered in residential building insurance. Let's put it on charge. Yeah. Movable property. This is a cat like you can say an add-on to the residential property because the residential building cover only covers the property and not the content inside that property. The movable property or the content insurance covers the content that you have inside your house. Then commercial building, similar to residential building, it is the property insurance. We have motor over here as well. This covers the motor first party liability, the liability to the insured product, like say the car itself. If you have hit a person, there might not be much impact to your car. But say if you have hit a pole, your car would also get damaged, right? So that cover would be covered inside property damage motor insurance. The damage to the car. So there are generally three covers in an motor insurance company. One is uh, first party, which is own damage. Motor property damage is called own damage cover. The next one is third party damage, third party liability. And the third one is the personal accident cover over here, personal accident. So if something happens to the person who is driving the car, personal accident cover has very like objective claim settlement features, right? Say if your one limb is damaged, you get certain amount. If both of your limb is damaged, you get certain amount. If one of your eyes is damaged, you get another amount. So in that thing, it is very categorically defined. If this happen, you get this. If this happen, you get this. That's why it is categorized under fixed benefit, because the amount is predetermined. It is given. There is no variability between the claim. If the claim happens, it will happen for that amount only, nothing in between. So there are three components of a motor insurance company: own damage, third party liability, and personal accident. The next two over here is the marine and the aviation property damage, right? Similar to motor insurance, a marine vessel or an aircraft, both would be covered in property damage. So the like most tragic event has happened right now, the Ahmedabad plane crash. So over there, the vessel got damaged, the aircraft. A lot of people were dead, unfortunately. So those things will be covered in an insurance policy. So the loss to the aircraft would be covered in the property damage, and whatever compensation or losses that is paid to the passenger or the family of those passenger would be covered in the public liability, right? So you need to understand in the for single product there could be multiple type of claims that could be paid. Could be property claims, could be liability claims, could be fixed amount of claims, could be personal accident. Different categories of claims could be paid. Right, same goes with marine insurance. Marine insurance also have two kinds of cover: hull, which is the loss to the vessel, and the other one is to the goods, or the if the marine or the ship is carrying passengers, losses to the life of the passenger, that would be covered in the liability part of the business. Is it clear? Next is financial losses. Financial losses are related to something happening to this business wherein some kind of financial loss, quantifiable loss has happened to you, to the company, that is paid. Pecuniary, fidelity, business interruption, cyber insurance, right? Fixed benefit, again, we have discussed. This is a fixed amount that is paid on occurrence of an event. Personal accident, we have seen. Health insurance is categorized in fixed benefit. Why? Because sometimes there could be that for some conditions, a fixed payment is done to you at a frequency. Say, if a terminal disease is detected, uh, fixed amount is paid to you till you survive. Or also for health insurance companies, some insured is fixed, like you take a 5 lakh, 20 lakh, 50 lakh, some insured, right? It could go as far as that only. And also for some kind of treatments, the amount is fixed as well. So for those reasons, it is categorized into fixed benefit, but the amount varies. The claim amount could vary in health insurance. The last one is unemployment benefit. Unemployment benefit is generally given by the government, wherein if you are unemployed for say more than a month, if you are actively searching for a job, you would get a fixed amount from the government for some period. Again, this is not in perpetuity. They are not promoting unemployment. It is for say 1 year. You are actively searching for a job, you are not getting one. So for that period, government is providing you some amount so that you can live your life as you were doing. So these are the basic kind of products. uh, you can read about them in detail. It's covered in the course material. If you have any doubt, we can discuss those in our next class. Moving ahead, we see the snapshot of the finances of the organization. So this is the balance sheet, the asset side and the liability side. Liability side is categorized into two part: technical reserves, free reserves. The asset side are fixed asset, current asset, and all the other investments. So whatever asset you hold, other than that, everything is either in your bank account or invested, right? So the total of liability and the total of assets should match. Basic concept. So let's understand what are the technical reserves. So this thing is most important. Technical reserves. What are covered under the technical reserves? So see, under the technical reserves, it could be split into outstanding claim reserves, IBNR, IBNER, reopen claim, claim handling expense, UPR, URR. Right. So 1, 2, 3, 4, 5, 6. 6 types of technical reserves are there. Let's understand one by one. You will understand the entire claim journey. If you understand the entire claim journey, you would be able to identify which claim is what. Right? Let's see. Let's continue with our example only. That there was a car, a man, a car hit the man. The event took in 2020. It was registered in 2022 and it was settled in 2025. Right. So at 2022, in 2022, when the claim was registered to the company, they didn't know what was the full amount that is to be paid to the victim, right? But Whenever a claim is registered to the company, there needs to be some reserve, some amount assigned to that claim. So, say in 1st September 2022, the claim was registered, and it was only registered. There was no quantifiable amount that was given to the company. They set a 10 lakhs amount against that claim. Now, what is happening? This is something that is set, nothing has been paid. The entire claim amount can be divided into several parts: paid, outstanding or case amount, IBNR. IBNR stands for incurred but not reported. Right? Over here, in this scenario, 10 lakh claim is set against the claim. Nothing is paid. We haven't calculated the IBNR. IBNR is something that we actually calculate, right? It is not given by the claim handler or the underwriter. Nobody gives you what is IBNR. It is something that you calculate. What all the thing that we are doing in this subject is calculating IBNR. So paid nothing. The entire 10 lakh is the case or the outstanding amount. IBNR is zero right now. Then you did all your calculations. You, by your past experience, seen that in this kind of claim, 15 lakhs are paid. 10 you have already been assigned for. The remaining 5 lakh, you, the actuary, would keep against that claim as a reserve, which is called IBNR, right? So you have paid case, IBNR, done. In this claim, only these reserves are affected. But say when you are doing your general reserving practice, you don't know how many events have been like. There could be that the event has happened, but you are not reported. You have not been reported with it, right? The claim has only happened. You don't know whether it has been reported. Like so, that's why you see over here they have IBNR and IBNER. So this IBNR is effectively IBNYR, incurred but not yet reported. So what it says that the event has already happened, but the claim is not reported to you. So when would be the case? It is this period. The event happened, but the claim is not registered. So say if you were holding 15 lakhs for this claim during this period, it was IBNYR. When you are at 2022, you have 10 lakhs, which is the outstanding claim, plus 5 lakhs, which is the IBNR or IBNER claim reported, incurred but not enough reported. The claim has been reported, but it is not enough. It could further develop. So this is IBNER. So IBNER is always for claims that has already been registered to the company, and IBNYR is for claims that has not yet been registered to the company. So if you are holding 15 lakhs between 2020 to 2022, it is IBNYR that you are holding. If you are holding 15 lakhs between 2022 to 2025, with a split of 10 lakhs and 5 lakhs. It means 10 lakhs is your outstanding claim and 5 lakhs is your IBN ER claim. Understood till here? Outstanding IBN YR, IBN ER. The next one is claim reopening claims reserves. It might happen that you have paid 15,000, right? But after some time, the person died, right? And some relative of that person came and again filed for reopening of the case, that the 15 lakh that was paid was for only injury, and now since the person has died, uh, we deserve more. So now the claim would be reopened, further payments would be made. So the company might hold some reopening reserves, which is not explicit, it is implicit to IBNR only. Like whenever you do a triangle calculation, whenever you do a chain ladder method, the first half of the triangle is your historical triangle. These entry would include everything: claim reopening, claim being registered, claims developing which was not registered. So if you calculate a development factor and estimate reserves, it would include everything. IBN ER, IBN YR, reopening reserves, everything would be there in that IBN IBNR number only, right? It is just the bifurcation that you can make in that reserves. So claim reopening reserves is kept for claims that might get reopened. And handling expense, this is the expense that is added to the claim. So for that 10 lakh 15 lakh claims, might be that you assigned a lawyer, you paid a 1 lakh fees to that lawyer, some claim handling paperwork was done. So in total 1.2 lakh was spent for that specific claim. So the total claim amount would become 16.2 lakhs and not 15 lakhs. This 1.2 lakh is the claim handling expense. This also comes in the technical reserves only, right? These things are related to past event period that has already passed, right? 2022 passed, 20 passed, half of 25 has also passed. So whatever things have happened till 2025 June, the events, the results that you keep for those things are past events, will be covered in outstanding reported claims, IBNR, reopening claim handling expense, all these things. It also happens that you have written a policy at the start of 2025, 1st Jan 2025, right? Today is, what's the day? 17th of June 25. So almost 6 months has lapsed, right? Not totally, but you can take 6 months. The policy is of 1 year. The policy will expire in 31st December 2025, right? Some events are yet to be happen over here in this period. You can't say that it would be covered in IBN YR. Why? Because if the day hasn't come, the event hasn't occurred, then it cannot be covered in IBN YR. Incurred but not yet reported. It hasn't got incurred. So uh, it is not covered in IBN YR. So how will you reserve for this? You will use URR, unearned premium reserves, unexpired risk reserve. So what is unearned premium reserve? So say if you have taken 100 rupees of premium and only 6 months have passed, so that means if you, again you need to take an assumption that you are earning the policy uniformly throughout the year. So you have earned 50% of the policy, 50 rupees is left, 50 rupees is your UPR. URR, what is URR? URR is unexpired risk reserve. Since 6 months is passed, only 6 months is left, there would be some probability that the event could occur in this 6 month. Say if an event occur, you have 80 rupees of claim. Since 50% of the year has passed, now you are saying that it is 50% probability that the event would take in the next half. There is no, again, there is no reporting delay over here. You are taking assumption of uniform earning, no reporting delay. So these things are very important, stating your assumptions. Whenever you make a case, you always have to state your assumptions. So this would say that 40 rupees of the claim could be paid in the next half of the year. So you have a 50 rupees of UPR and now 40 rupees of URR. So that means you will earn 50 rupees and you might pay 40 rupees. So you don't have to keep anything extra aside for covering the risk for the next part of the year. This is generally the case. Uh, Most of the company don't keep extra reserves for the unearned and the unexpired risks. It keeps just the UPR, assuming that 100% of it would be paid. So only the UPR is kept as the reserve. But sometimes it could happen that the loss ratio, or you need to pay more than what you have collected. In that case, there is another reserve that you need to keep is AURR, additional unexpired risk reserve. So say instead of 40 rupees, you calculated or expected a 55 rupee claim to be paid for 50 rupees that you collect for the next half of the year. You need to keep aside an additional 5 rupees to cover the risk. So this 5 rupee would be AURR. If it is too much, we can take a pause, grasp all this thing. If needed, we can repeat as well. So over here, this UPR and URR is something which is tricky. Other than that, IBNR, IBN, ER, YR, those are still easy to understand. This could take time. Nothing to worry. Let's start again. Let's start fresh. So over here, 1st of Jan, 30th June, 31st of December. 6 month has lapsed. You premium collected at the start of the year is 100. Since half of the year is lapsed, what would be earned? Earned premium is 50. So what is unearned premium? It is 50. So this is UPR, unearned premium reserve. That's it. Now you have taken, you have seen that for the policy that you are selling, there is a 80% loss ratio, right? So for every 100 rupee, you pay 80 rupees. So for the 50 rupees unearned part, what is your expected claim? That is 40. So this is URR, unexpired risk reserve. So this 40 rupees is for that part of the risk that has not been expired yet. Right. Now URR is less than UPR. This is mostly the case, because if this is not the case, you have not correctly priced your product. So in the long run, if you consistently have this scenario, then it's a matter of concern. You need to revisit your pricing uh, methodologies. So this is the method. This is the situation that we want to be in, and not in the other situation. This is not the situation that we want. If, but say, if this is the situation that URR is greater than UPR, in our example, 55 URR, 50 UPR, you are short of money. In the next 6 months, you, for argument's sake, you can say we will receive 50 rupees, but we might need to pay 55 rupees. Where does this 5 rupee come? This 5 rupee is the additional URR that we would keep. AURR. This 5 rupees is the AURR that we need to keep in order to balance the situation. Is it clear? AURR is not given in this PDF. Okay, sorry, it's given. UPR and AURR. UPR, URR could be interchangeably used, since I said that most of the company doesn't keep AURR, they just keep UPR as their reserve, assuming 100% loss ratio. So from the reserving standpoint, we only have UPR and AURR. But in order to understand AURR, you need to understand URR as well, right? So let's understand uh, by this table over here. Outstanding claim reported, incurred but not enough reported, incurred but not yet reported, reopened claims, claim handling expenses. These are related to already happened events. These are outstanding claim reserves, also known as OCR. In your exam, if you see this OCR, it means it is hinting on these reserves. Then we have future event reserves, UPR, URR, AURR. Then again, there are some optional reserves. The company might keep it, might not, on their free will. Claim equalization reserves, catastrophic reserves. CAT reserves are for large events, very large events, low frequency, high severity. Say 1 in 10 year, 100 year. COVID, COVID is a 1 in 100 year event. The company might keep some amount every year to stack up for those losses. If that loss is again repeated in next 100 year, they could pay from that cat event uh, reserves. That is not like truly a cat event. That is considered as a threat event, because those kind of event could lead to a closure of the company as well. It is a threat to the entire industry. Cat events are generally flood, typhoon, hurricane, snowstorm, hailstorm, landslide, wildfire. Those are cat events. So company might keep separate reserves for those low frequency, high severity claims. Claim equalization reserves. Claim equalization reserve is very subjective reserves. Not all company keep this. Let's understand what is claim equalization reserve. So in 2024, 23, 25, the company in 2023, the company has a profit of 100 crores. 2024 also, the company had a profit of 80 crores. And 2025, the company is expecting to have a profit of 90 crores. So what do we understand by this? We understand that the company is targeting a 90 crores profit each year. So in 2023, when the company is having a 100 crore profit, what it would do? It would keep a 10 crore claim equalization reserve. This is the reserve that the company has kept in order to stabilize its position in case in future it is not able to make this similar kind of profits. So this 10 crores could be used in this 2024 when they are short of 10 crores and can release this 10 crore can and have 90 crores, or not. If not this, over here in 2023 we have a 100 crore profit. Uh, this was not that we were targeting, overachieved. We kept 10 crores. Next year we have a 90 crores loss to pay and a total income of say profit, like, and 80 crores in our bank to pay those claims. We are falling short of money. We can use this 10 crore, we can balance this, we can pay off the claim. So claim equalization reserve in nature is for balancing shortfalls in future years, situations that may arise in future. For those, we have kept reserves from some good years to balance the bad years. So that is the uh, simple concept of claim equalization reserve, keeping reserves from a very good year to balance out the situation in a bad year. After that is free reserves, asset or shareholders fund. For a public company, private company where shareholder is the owner, whatever is remained after this could be divided to the shareholders. It is the shareholders fund. Free reserves could be used for growth, could be kept for future. So these things, as it says, sometimes are part of free reserves as well. That the company hasn't kept it explicitly, but we have some free reserves could be utilized in future, right? Not directly distributed to the shareholders, not directly uh, used the growth of the company, kept for future growth or future events of the company. Is it clear? So this same only, not yet happened. You can see if there is something different. I don't think so. There is any different in this page. The last topic over here today is the claim characteristics. This over here is very important, very important. Don't neglect it. Don't think that it is the first chapter, so it won't be important. This is very important in order to construct your answers. You would see that most of the answers when you construct, you need to You need to take into consideration what type of policy, what type of company it is, and what are the characteristics of the claims that would be registered in the company. Basis that only you would you would give your answer. So this claim characteristics is very important. Could be asked directly or could be used in your answer. You need to think how do you need to answer it. So what is the mnemonic for claim characteristics? Craft, cramps, vents, drills, catastrophe, reporting delay, accumulation, frequency, trend. So let's understand how do we read it. If a claim, if we are talking about a business, an event that has happened, say the question says that a company, a general insurance company, is writing product liability businesses, and you need to reserve for it. Product liability business could have catastrophic events. So you would say about catastrophic events, we can reserve for catastrophic events. For a general insurance company, reporting delay and settlement delay is there. But since this is a property claim, I said for property claim, the tail is short, reporting and settlement delay is not that long. So, keeping that in mind, we will answer since the reporting delay is not long, we might not keep much IBNR because since the reporting delay is short, the settlement delay is short, most of the amount would be covered in the case reserves, and we don't have to keep that much IBNR as compared to the liability claims. Again, right? Accumulation. What is accumulation? Having concentration on a specific policy, product, region, those types of accumulation is accumulation risk. Like say if you are writing household policy, right? You have written policies, you have given policies to all the house in the same neighborhood, and you have written policies in that neighborhood only. There were say 1,000 houses in that neighborhood, and you have written given policies for all that 1,000 household. On paper, you are saying that I have written 1,000 policies. I have done diversification. Like law of large number is applying to me, but in reality, you have given policies to everyone who is affected by same events. So that means you have a concentration of risk in that region. If something happen in that region, it could affect all 1,000, most of the house, or more than one houses, right? So that means you have an accumulation risk. You need to consider that as well. Then frequency. If it is a cat event, low frequency, high severity, we need to comment on that as well. Trends. What are the trends that could be seen in type of in those in the product that you are writing? Currency. If you are only writing in domestic region, local policies you are writing, it would be in your domestic currency only. But global insurance company, they write policies across region out of their currencies as well. So they are affected by foreign exchange rates as well. Fluctuation in foreign exchange rate also impact them. So you need to comment on that as well. Reinsurance, if you have taken reinsurance, default of reinsurance, not timely recovery of reinsurance, how much, what kind of reinsurance you need to take. If you are doing a property policy, they are generally of similar nature. Quota share is the best type of reinsurance that could be taken for that kind of uh, say that characteristics policy, right? So you need to comment on what type of reinsurance could be taken basis the characteristics, other characteristics, amount, sum insured, if it is a high sum insured, low sum insured policy that you are writing. ba- On that also you might take some decisions. Like if it is very small amount sum insured that you have taken, not much risk, no accumulation, very safe you are playing, you might not take reinsurance. Right? Moral hazard. What is moral hazard? Moral hazard is when a person who has taken the policy is behaving casually than they would have otherwise uh, behaved when they didn't have the policy. Like after having the policy, the nature changes, which would make it more likely that they claim. They became careless. You have taken motor insurance policy, you know that you have a insurance. If you hit, if anything happens to your car, uh, claim will be paid by the company. So what are you doing? Whenever you have parked your car, you didn't lock it. You didn't lock it. You left your key in your car. So it's an invite to the robber, right? Come and take my car. So this is a moral hazard that after taking the policy, your behavior has changed, and this is making it more likely that the claim will happen. Partial payments. So mostly for general insurance company, everything, all the payments is made in lump sum. But at some cases, the claims are paid partially as well. Partially means in installments. So say we were taking example of a person injured in a coma, unconscious, lying in hospital, right? The he they had a family. They, they have a family. The family made a uh, claim or registered sued the person. So what the court has said that as long as the person has not recovered, the insurance company will the pay for the hospitalization bill. So the hospitalization bill need not to be paid at the start only. It is to be paid as and when it occurred, every month, every week, right? So what the company is doing, the company hasn't given the entire the entire claim amount directly to the company, to the insured or the party, third party who is impacted by it directly. What they are doing is they are paying the hospitalization bill in installments every month. So that is partial payments, installment payments that the company is doing. So whether the policy that you are selling has this partial payment in it or not. If there is partial payment, then you need to say invest in very liquid assets, right? Because you would need money next month also, month after next also. So you would need liquid cash to pay those amount. So partial repayment would uh, tell you what investment decision you should take. Settlement delay, we have discussed with reporting delay. If it is short, your decision would change. If it is long, you could go with a longer investment, equity investment, right? You would have more investment income, prices could reduce, multiple things could happen. Volatility, property claims have uh, low volatility, liability claims have high volatility. Event delay, event delay is something new. No, so what is event delay? This generally happens for say medical issues. Uh, say a person was working in an industry. surrounded by heavy machinery. He worked for 10 years, 2000 to 2010, right? He developed a situation, hearing situation, or say if he worked for in a uh, polluted area, that they might uh, develop a lung disease also. So they have developed some kind of disease, but they don't know it right away. After 10 years that they have left the job, they have retired, they were diagnosed with that disease, and it was investigated that because they were surrounded in those region, because of that, these disease has they have got this disease. So what happened? The event took place very long time ago, right? In 2010, before 2010 only, because uh, in 2010 they retired, right? So from 2000 to 2010, they worked, and they might have be exposed to that environment in this period only. And coming to 2015, they were diagnosed with it. So what happened? The event took place somewhere in this time. It was diagnosed in this period. So there was an event delay. The event happened, but we were not aware about that the event happened. In reporting delay, the thing is, we know that the event has happened, but due to some reason, there is no one to claim. But in event delay, the event has happened. The person who is exposed to that event, he only don't know that uh, I am exposed to it. So if there is a event delay. Understood? What is the difference between event delay, settlement delay, and reporting delay? Next is nil claim, definition, and seasonality. Definition is very subjective. What is the definition of the claim? When we, like what is the policy wording says? When can you make the claim? Some exclusions could be there. So what, depending on what is the definition of the product that you have sold, you would make some decisions. Nil claim. Nil claim means the claim that is registered in the hit and run case only. Say the case was fought in court, and then it was established that the person who was hit was not in his conscious. He was under the influence of alcohol, maybe drugs, maybe he was there to suicide, right? So it is proved that it was not because of this person's negligence. It was because of this pedestrian's negligence only that the accident has happened and he got injured. So in that case, what would happen? The court will say, since this person was guilty, this person was guilty, the insurance company doesn't have to pay anything. This car person is free. Nothing will be paid. The claim is closed. Nothing was paid. The claim was settled as nil claim. So nil claim is when a claim is registered to the company and it get closed without paying anything. Seasonality. Seasonality, as the name suggests, the claim is very seasonal. Say at some part of the year, it is most likely that these things will happen. So in those part only, we have high risk. In other years, there is low risk for that events. So this is seasonality. Distribution. Right over here, distribution, we mean distribution of the claim. Uh, what distributions of claim you are following? Sorry, sorry. By distribution over here, we mean the distribution channel of the policy, by which medium you are selling the policy, whether it is direct, directly over from your website, from an agent, from a dealer, from a say bank, right? There could be different channels from where you can sell your product. Say if you are taking a loan, the bank would say that with this loan, we will sell this insurance to you to protect our loan amount. So the bank is selling to you that policy. If when you go to buy a car, the dealer is saying, car dealer is saying, you cannot take the car out from my warehouse without getting insured. So what he does, he sells you a insurance that I have done your insurance, now you can take it. So the dealer has done your insurance. Other than that, health insurance, you contact some agent, right? Could be a relative, uncle, say some distance friend, family, father's friend. Anyone can be there who is doing your health insurance. So this is your agent. Others could be directly from company's website, say from X company's website. You have searched for the product. You were navigated to the company's website. You fill in your detail and bought the product. The others are aggregators, Policy Bazaar and all. You can buy policies from there as well. So, what is the medium of the policy that also tells you how the losses would be? Because if the policy is sold directly over the website, there would be less screening. Could be that the person has falsely given the information. He was a smoker and have said that I am not a smoker. Health screening was not done. The high risk policy. But say if agent has sold the policy, the agent would know the person, or it is sold through say bank loan, that you have taken a loan, you might have taken other loans. Bank knows about your default rate, they know about your CIBIL score, what is your credit liability credibility. They would know that if you will pay her loan or not, whether the claim is likely to be made or not. So if it is sold through those medium, it is most likely that full screening has been done. It is a low risk policy, low loss ratio policy. And from other uh, channels, it could be that less screening, high risk policy. And also the commissions are also based on the distribution channels. Bank might take more commission than an agent, and there might not be any commission on your own website. Aggregator might want extra cut to list your product up in the list. So there could be different expenses and commission depending on the distribution channel. Reopen claim, whether there is a situation of reopen claims in that kind of claim. Inflation, how does inflation impact the claims? Latent claim, we will discuss it in a while. Large claim, we have uh, understood what is large claim, which is outlier, not general. Salvage and subrogation. So two things we need to discuss: latent claim, salvage, and subrogation. Latent claim is claim which takes a lot of time before it get identified. The example that I took for uh, the lungs disease or the hearing aid disease for the person who is working in a factory. Asbestos claim, if you know, asbestos is a chemical which impact your lungs. So that chemical was used in the construction industry in early 2000s. It was banned by the company by the government in early 2000s, and people are still suffering from those diseases due to that asbestos chemical. Claims are getting registered now also. So since we have a 20 years, see we have a 20 years delay. So those large delays is called latent claim. Claims that have such large delays is categorized as latent claim. In property insurance, the latent claim is not there, but for liability insurance, we might have latent claims. So depending on that, also you need to do your reserving. You might need to add a tail factor. See, say you are a company who is registered 5 years back. You have only 5 years of data, but the business that you are writing takes 10 years to develop. So how can you say that when you are doing a chain ladder method, first accident year is fully developed? That is one of the assumption, right? When you are doing chain ladder method, that first accident year is fully developed. This assumption would not be fulfilled. In that case, you need to add a tail factor. So those things will depend whether you have a latent claim or not. The last thing is salvage and subrogation. This again is prominent in property claims, car, aerospace, marine. If say your car was lost, it was stolen, you lodged a complaint, you made a claim, the company paid the entire claim amount to you, then the company would contact the police department. The police will search for your vehicle, and in case your vehicle is found, then in that case, that vehicle will not be your property anymore. That is the insurance company's property. So subrogation is transfer of right of the property. Since the company has paid you the claim, now if anything is recovered from that, it is insurance company's property. Salvage is the recovery that is made, and subrogation is the law which says that once the claim has been paid, the property moves to the insurance company. So, salvage and subrogation together means any recovery that is made by selling the uh, insured item that belongs to the insurance company. Any recovery that is made is insurance company's recovery once the claim has been paid to the insured. So that means salvage and subrogation. If it is a property insurance, there could be salvage and subrogation. You need to incorporate that also in your decision making, answering, pricing, everything. So you would see that while discussing the claim characteristics, we have discussed about reserving, pricing, investment. How will the claim characteristics impact all of your decision? So this is very important. You need to learn this mnemonic. You need to buy hard this. This will be of very help. Craft, crams, when drills. Okay, you can write it multiple times, and every any time you get time, write craft crams, when drills, craft crams, when drills. You would it will be in your mind, and you would remember this. The last one is short tail, long tail business. We have already discussed this. What is short tail? What is long tail? So this is the end for today. Uh, we have completed first chapter, the introduction to the reinsurance, to the insurance, general insurance. This is common for SP7 and 8. If you have any doubt in the chapter, you can message in the group. We have groups for SP7 and 8. We take doubts in there. We have video recorded as well. You can again refer to that videos. We have 100 hours video recorded. So you can refer to the video. Uh, if then also it is not cleared, we can take doubts in the live classes. We can arrange separate concept clearing classes. But The point is, you need to put in effort. We can only discuss concepts, you can only solve questions in the class. Unless you do your self study, you won't be able to remember these things. And in order to pass the exam, in order to write a good answer, you need to know your theory. People would say that you don't need to remember, it's like open book, they don't ask direct questions. But believe me, unless you know your theory, you won't be able to write your answer. It might not be directly asked, but to write a good answer, you need to know your theories. So I hope the class was clear to you. If you have, in case you have any doubt, do message, do reach out. We will be aiming to solve every doubt. We have videos. Please do watch them as well at your convenience. We will have regular classes also. Thanks for joining. Uh, okay. Thank you. Bye.